Assalamualaikum and greetings to Dr. Aziz. I am Nurul Qhyizatul Nafizah Binti Suhaimi and I will present the contents of our research topic for MGT646 course, which is the determinants of non-performing loans in Malaysia's banking sector. Before I peel back the layers of each topic, I would like to start with a brief introduction to the banking system and the concept of non-performing loans. Financial institutions play a crucial role in ensuring the economic stability by facilitating the financial services. Banks act as an intermediaries, provide us with various services including fund management, lending, safeguarding, and investment. They generate profits by receiving deposits and offering loans to the individuals, businesses, and even the government agencies. The efficiency of banking operations reflects a country's financial stability. In simply put, a well-functioning banking sector, it promotes the economic growth and the financial stability. Conversely, poorly managed banks can negatively impact the economy and the society. Therefore, it is essential for the regulators to ensure that the banks operate effectively and well managed to support the economic as well as the social well-being. However, since one of the bank's function is extending credit to customers, it inevitably faces the challenges of loan defaults, which leading to non-performing loans. So non-performing loans or NPL, it refers to the loan where borrowers fail to meet repayment obligations for a prolonged period, typically 90 days or more. And high NPL levels indicate the financial distress, which affect the bank profitability and the economic stability. The causes of NPLs can arise from multiple factors, including the borrower's personal situations, issues within the bank itself, and broader economic conditions. Firstly, on the individual side, borrowers often face significant financial challenges that can impact their ability to repay loans. For instance, the borrower may face financial difficulties due to job loss or poor financial management. If a borrower works for a company that is having money problems, they might be affected when the company cannot pay its employees. The company might have to lay off workers or even go out of business, which means they face bankruptcy. And this directly affects the borrower's income as they may lose their job or get paid less, and they may struggle to pay back their loan because they no longer have a steady income. And this makes it harder for them to meet their financial obligations. On the bank side, poor credit evaluation and risk management can lead to non-performing loans. For example, if a bank it doesn't properly assess a borrower's ability to repay a loan, it might lend money to someone who is not financially stable, and this increases the likelihood of the borrower defaulting on the loan. Additionally, from an economic perspective, unfavorable economic downturns such as the COVID-19 pandemic can worsen the NPLs. During tough economic times, many people and businesses face financial struggles like losing their jobs or experiencing lower sales, and this makes it harder for borrowers to repay loans, which lead to an increase in defaults. Next, we go to the problem statement, research question, and research objective of this study. The rising trend of non-performing loans in Malaysia's banking sector signals increasing financial instability. In Malaysia, fluctuations in macroeconomic factors such as interest rate, GDP, inflation, and unemployment rate raise concerns about their impact on NPLs, thereby threatening the profitability and stability of the financial institutions. These factors, when combined, it creates a cycle that can jeopardize the health of the banking sector and the broader economy. While various studies have explored NPL determinants, there is limited research focusing specifically on Malaysia's banking sector over an extended period. This study aims to bridge this gap by analyzing key macroeconomic variables affecting NPL. Therefore, based on the problem statement, our research addressed these following questions. How do macroeconomic factors like interest rate, GDP, inflation, and unemployment rate could affect NPLs in Malaysia's banking sector? And which variable has the most significant impact on NPL? To answer these questions, the objective of this study are to examine the relationship between NPLs and key macroeconomic indicators and to determine whether interest rate, GDP, inflation, and unemployment significantly influence NPL levels or not. Moving on to the chapter 2, which is the literature review part. In this chapter, I will focus on the explanation of the dependent and independent variables that are involved in the study. The dependent variable is non-performing loans ratio. So as I mentioned in the previous part, non-performing loans, it refers to a loan in which the borrower has failed to make the required payments, either it is a principal or interest, for an extended period, typically 90 days or more. Once a loan becomes non-performing, it is no longer generating income for the lender, and it is considered to be at risk of default. NPLs are often used as an indicator of the financial health of a lending institution, as a high level of NPLs suggests a potential issue with loan repayment and can impact the institution's profitability and stability. Our independent variables include interest rate. The interest rate is the percentage charged by a lender to a borrower for the use of borrowed money. It represents the cost of borrowing and is usually expressed as an annual percentage of the loan default. Central bank and financial institutions set interest rate to influence the economic activity, such as consumer spending and investment. Next, we have GDP. GDP is the total value of all goods and services produced within a country's border over a specific period. Typically, it measured annually or quarterly, and it is an important indicator of a country's economic performance, which reflects the overall economic activity, growth, and standard of living. Inflation is the rate at which the general level of price for goods and services rises, eroding the purchasing power of money over time. When inflation is high, each unit of currency buys fewer goods and services. Central banks, it often aim to keep inflation at a stable, low rate to maintain economic stability. Unemployment rate, it refers to the percentage of the labor force that is actively seeking work but is unable to find employment. High unemployment rates can indicate economic distress, while low unemployment typically suggests a healthy economy with ample job opportunities. Unemployment can be caused by factors such as economic recessions, technological changes, or structural shifts in industries. Next, we go to the chapter 3 of our study, which focuses on the methodology used to analyze the factors influencing NPLs in Malaysia's banking sector. This chapter outlines the data collection methods, analysis techniques, conceptual framework, and hypothesis development that guide our research. For this study, we rely on secondary data collected from reputable sources, including from Bank Negara Malaysia, Annual Financial Reports, World Bank, and the Department of Statistics Malaysia, and our data covering the years 2013 to 2022. To analyze this data, we employ various statistical and econometric techniques, including descriptive analysis, Bruch and Pagan-Lagrangian multiplier test, regression analysis, diagnostic tests, autocorrelation, and Hostman test. To test the relationship between macroeconomic factors and NPL, we establish the following hypothesis. Through this analysis, we will determine whether to reject or fail to reject this null hypothesis, which provide insights into factors influencing NPLs in Malaysia. Now we go to the next chapter, which is findings and analysis. Firstly, we discuss about the descriptive analysis. It summarizes and organizes data to understand its characteristics. It includes measures such as mean, median, standard deviation, skewness, and kurtosis. It provides an overview of the data set and identifies trends, patterns, and outliers. It also helps us in initial data interpretation before applying statistical tests. Our descriptive analysis provides an overview of the trends in NPLs and independent variables over this study period. The results indicate fluctuation in NPLs corresponding with changes in macroeconomic factors. Next, we have Bruch and Pagan-Lagrangian multiplier test. It determines whether a random effect or fixed effects model is more appropriate in panel data regression. It tests for the presence of random effect. If the null hypothesis is rejected, the random effect model is preferred over the ordinary least squares or OLS model. If the null hypothesis is not rejected, that means OLS is suitable. For example here, our null hypothesis, data is pooled ordinary least squares model, and alternative hypothesis, data is random effect. Based on our result, the findings indicate that the Qhyizatul squared value is 195.24 with a p-value of 0.0000, demonstrating strong statistical significance. This implies that the random effects model is more suitable than the pooled OLS model. Diagnostic test, it checks whether regression models made assumptions, ensuring the reliability and validity. In this test, we run the multicollinearity and heteroscedasticity test to ensure the regression results are not biased and to improve the model accuracy. Multicollinearity, it happens when two or more independent variables in the regression model are too closely related. This is a problem because independent variables should not be strongly connected to each other. To check for multicollinearity, we use the variance inflation factor, the VIF. If the VIF value is below 10, there is no serious issue. If it is above 10, it indicates a strong correlation which can affect the model. In this case, the VIF value is 6.12, which is below 10, meaning there is no multicollinearity problem in this model. Heteroscedasticity means that the spread of errors in the model is not consistent across different observations. This can cause problems in regression analysis because it affects the reliability of the result. The results show a test statistic of 31.82 and a p-value of 0.0000. Since the p-value is less than 0.05, it confirms that heteroscedasticity is present in the data. Autocorrelation occurs when error terms in a regression models are correlated across observations, violating the assumption of independence. And this test is to ensure the errors are independent over time and prevent misleading regression estimates. The test results show an F statistics of 101.709 and a p-value is below 0.05. This means the data has a serial correlation issues, indicating that past values influence future values, which could affect the accuracy of the model. The Hostman test. It is used to determine whether a fixed or random effects model is more suitable for our data. And based in the hypothesis here, null hypothesis, random effect model is appropriate. And alternative hypothesis, fixed effects model is appropriate. So, based on our findings, since the p-value is higher than 0.05, therefore we fail to reject the null hypothesis. This means there is no significant difference between the fixed effect and random effect models. So the random effect model is the better choice for this analysis. In summary, this study discussed the determinants of NPLs in Malaysia's banking sector by examining the macroeconomic factors, namely interest rate, GDP, inflation, and unemployment. And our study found that among these four macroeconomic factors, only interest rate exhibits a significant positive relationship with NPLs. This suggests that when interest rates rise, the cost of borrowing increases, and it leads to an increase to the likelihood of loan default. Based on our findings, we propose a few of key recommendations to improve the financial risk management in Malaysia's banking sector. Firstly, enhanced macroeconomic monitoring is essential to track the changing financial landscape and anticipate potential risks to the banking system. By closely observing interest rate movement and their impact on loan defaults, policymakers can implement timely intervention to mitigate financial instability. Additionally, the adoption of predictive analytics and machine learning can greatly enhance risk assessment capabilities. Advanced analytic tools can detect early warning signs of financial distress, which allow the bank to take preventive measures such as restructuring loans or offering alternative repayment plans before default occurs. This technology-driven approach would strengthen the resilience of the banking sector against macroeconomic shocks. Furthermore, strengthening risk management frameworks is necessary to improve banks' preparedness for financial uncertainties. Implementing stress testing, scenario analysis, and credit risk assessment models can help banks assess their exposure to adverse economic conditions and formulate effective strategies to mitigate potential losses. From a regulatory perspective, developing strategic policy solutions is crucial to address systemic risk caused by macroeconomic fluctuations. Policymakers should consider policies that balance economic growth with financial stability, such as adjusting monetary policies or introducing regulatory guidelines to help banks manage NPL risk more effectively. Finally, banks should focus on enhancing borrower financial literacy and support programs to reduce the likelihood of loan defaults. Many borrowers struggle due to a lack of financial knowledge or unforeseen financial difficulties. So, by offering financial education, debt management programs, and loan restructuring options, banks can help borrowers manage their financial obligations more effectively, which reduce the overall level of non-performing loans. Overall, this study highlights the importance of macroeconomic factors in influencing NPLs, particularly interest rate. Further research should expand the dataset to include more banks and explore additional economic and regulatory influences on the NPL trends.